Hello, everybody. Welcome to another edition of CNF Talks. Today, it's my pleasure to have with me Caroline Phillips, who's a partner and head of debt capital markets at Slaughter and May. Caroline is going to be joining us and speaking at the Making the UK a Global Hub for Transition Finance Summit, which is being held in London on the 10th of October. Caroline, welcome.
Thanks, Maurice, for that welcome. I'm very much looking forward to the summit, so it's great to be here.
Fantastic. Let's turn to our first question, if we may. What are the main challenges that need to be overcome in scaling up both labelled and general corporate financing to the levels that are required for the transition?
Well, there are currently quite a number of challenges, actually, but I guess that means there's opportunity for change. So I'll just touch upon a few. Although improving picture, given the regulatory push we've seen in a number of jurisdictions, I think there's still a lack of granular and comparable corporate disclosure on climate transition. And that does make it hard for financial institutions to identify which companies they should finance in line with their net zero targets. There's also a challenge, I think, around commercially viable projects and those that meet financial institutions and investors' criteria for transition investment. Another challenge I see is the variety of definitions in transition finance,
Yes.
which whilst there are common threads, there is a lack of consistency, and I think that could be a hindrance. I think it would be very useful for market participants if they had guardrails that they were operating in, and without them, that can hamper deployment of capital. And another challenge, I guess, is that this is a global issue, but the nature of the net zero transition is country dependent. It depends on domestic, social, economic circumstances and different policy approaches in different jurisdictions. And because of that divergence, there's not a global pathway to net zero. And so there's no common benchmark for alignment. And so that can make it challenging, particularly if people have concerns around greenwashing, and that could be perceived to be higher because of this lack of commonality. Another challenge is lack of economic incentives. So there's not really the real push for investors or the borrower issuers to expend time and resource and potentially risk reputation if something goes wrong. So perhaps if there were tax incentives or there was more favourable capital treatment, that would help. And a final challenge, I guess, is the real economy. Large corporates and financial institutions, they have the support, both in terms of skill and capital, to support transition. But the SMEs, who are key players, may not have that. And until they have that could be a hindrance, I think, to supporting transition.
No, indeed, interesting points. If you're an issuer, a company that's looking to issue transition-linked financial products, but what are the key legal considerations? And in terms of disclosure requirements, what are the things that they might have to disclose that for other types of financing they wouldn't? And are there issues with compliance and risk management?
That's a really good question. I'll try and unpick that a little bit. So I think the mood music has definitely changed, actually. I advise a lot of issuers and borrowers. And 4 or 5 years ago, I think people were really excited to be issuing sustainable finance products, to be seen as market leaders and to be seen as a marketing tool for a company's ESG credentials. Yeah. I think that's still the case in a number of parts of the world. But I think in the UK anyway, my experience is companies are much more wary now of stating their strategy through the use of financing products. In part, that might be the higher interest rate environment and the volatile markets where access to market is quick. And so there's a sort of cost benefit versus risk analysis that needs to be underdone. But in part, I think it goes actually to the heart of your question. I think now there's a clearer understanding of risks, both legal and reputational, which arise of issuing KPI-linked financial products. Yeah. So going back into your question, in terms of legal considerations, these do slightly differ depending on the type of product that you're going for, and whether you're in the capital markets where it's driven by sort of best principles and standards, or whether it's in the private market, so the loan market, where again there are principles, but it's also dependent on lending bank policy requirements as well as evolving market practice. So for green bonds, sustainability-linked bonds, use of proceeds bonds, and sustainability-linked loans, there are now established voluntary principles, and those principles are actually very widely adopted. So if I'm advising an issuer or borrower, obviously that's a clear place to start. For transition linked products, there is guidance, but just not at the product level. Now, that was a deliberate decision, I think, that was taken by the principals to have a climate transition finance handbook for the various principles for the products. So if you're issuing transition labeled products that are sustainability linked, that gives you more flexibility in terms of what you use the proceeds for, but that market has gone quiet, so that's a challenge. And I think until transition plans become more embedded and we have further guidance and taxonomies on transition products, it's difficult to get traction, I should say, for transition bonds. So in Europe, we haven't seen that momentum. But if we look at Asia, we have seen government policy, for example, in Japan, and clear guidance, and that can really drive issuance of transition products. When I'm advising an issuer or a borrower about loans and bonds, they need to think very carefully about how their KPIs are drafted and how that aligns with strategy. And I think there's a real concern as to KPIs being set today. Will they be appropriate in the future? And what do you do in that circumstance? So that's both in terms of the legal perspective, but also from an investor relations perspective. Now, anyone that's in the DCM world will know that consent solicitations can be challenging and expensive exercises. I mean, in the loan world, even though the economic incentives are limited for meeting your KPIs or failing to meet your KPIs, so the needle on the margin doesn't move much, given the lender's reputational concerns, if you miss a KPI and you want to change it, it tends to be an all lender consent. So borrowers are worried about the risk that they go out with a KPI linked product and then they find out that they can't amend it easily, or that they have to de-recognise it, which is obviously reputationally damaging. In terms of disclosure for bonds, as well as explanation of the selection of the KPIs and the SPTs and how the penalty mechanics work, there has to be disclosure around timelines for the achievement of the targets, the reference point that's selected, the circumstances for the calculation, and how the issuer intends to reach those targets. And you also have to think carefully about your risk factors in an offering document for a bond. So making sure that the market understands there's no assurance that you will have, say, a suitable investment for all investors seeking exposure to assets with sustainability, that there's no assurance that you will meet your targets, and to explain that actually no event of default arises if you don't. And so there are all sorts of considerations to think about, and it's obviously very important to get disclosure right, to provide enough detail for investors to make an informed decision, but to minimise the risk of future litigation and reputational damage. Another challenge, I think we're talking about challenges in the earlier question, is thinking about reporting and availability of data. So typically reporting is required annually and during the target observation period. Often that information comes from a third party source. So the ability to meet agreed timelines can be outside of a company's control. And for some of my clients, that lack of certainty does cause nervousness. And then, of course, there's the recommended third party auditor verification process. And I think for a company, particularly if it's your first product, that can be time consuming and an intensive exercise. And there are obviously some questions still over credibility. So there's lots and lots to think about if you're an issuer or borrower and want to go forward with sustainability linked products or use of proceeds products.
So, I mean, it sounds like it's quite challenging for issuers. I suppose once they've been through the process once, it comes a little easier. But if I were an issuer and I was considering the various types of product that I might want to use either to burnish my credentials or indeed to align with my strategy, if I was looking at the KPIs for the various products, is there a huge difference between those for, say, for sustainability-linked bonds versus sustainability-linked loans or private placements? Is there an optimum choice? Is it easier for private placements and loans versus bonds, for instance?
Well, I guess the difference between loans, sustainability-linked loans and sustainability-linked bonds or private placements is the bonds, you're in the capital markets and it's a public issuance. Whereas in a loan, although you may have a large syndicate or you may have a relationship club, it depends on the dynamic, or a private placement, it may be bilateral. It's a more private process. I don't think that necessarily should influence the KPIs you're setting. I'm very much of the view that the business of your transition should lead the KPIs, and the KPI shouldn't be crafted the other way. It shouldn't be that the
Yeah.
financing is the tail wagging the dog.
Yeah.
And so, but careful consideration does have to be given. And I think the fact that on the bond side, getting amendments through would be a significant process. You do have to think very carefully about that. And I think some of the litigation challenge that has come. So if you look at the SEC, where there's been challenge around, for example, Adani had some challenge, and a Brazilian company also had some challenge around their KPIs. I think that has made people really, really focus on it. And with my clients who've been looking at KPIs, the one that's caused real challenge is actually scope 3,
Yes.
and looking across the supply chain. And I guess the challenge with that is the underlying data and making sense of the underlying data and being confident in the underlying data and the audit of it. So there are lots of considerations. They're probably more acute on the SLB side than they are on the SLL side. And I think I've seen that in my practice. A couple of years ago, I would say a high percentage of the loans I was doing was SLL, but a very small percentage of the bonds I was doing were SLB. Whereas in the bond market, the use of proceeds products, so the green bonds, the sustainable
Mm.
bonds, they were very popular with clients and successful.
Mm. Interesting. And in terms of trying to clear away some of the uncertainty and ambiguities, do you think that the EU Green Bond Standard will help and sets a benchmark that people will aim for?
I think it's a gold standard, and it's a
Mm.
very hard standard to achieve. I mean,
Mm.
I'm not expecting significant issuance under the EU GBS label. I think some Supras will issue under that, and they will lead the market. I think there are elements of the EU Green Bond Standard which will have wider ramifications in the market for those who are not necessarily issuing EU GBS, but are issuing
Yeah.
green bonds, say under the ICMA guidelines.
Yeah.
So, for example, the fact sheet, I think, will help describe drive disclosure. And I think the sort of parameters around third party verification
Mm.
and will drive credibility in that area and make it more robust.
Mm.
So do I think we'll see lots of EU GBS issuance? I guess I don't,
Yeah.
because of the 85% requirement of meeting the EU taxonomy, which will be very difficult for people to achieve. But do I think it will help push standards up in the
Mm.
market? I think it will.
Mm. Interesting. Finally, because I think we're slightly running out of time here, if you're a company, what are the pros and cons of using label products versus general corporate financing for transition needs? I mean, some of them are obvious, I suppose, in terms of you're making it more of a statement with label products. But what would your advice be to a typical issuer who is debating which way to go?
I think it's very difficult, actually.
Mm.
I would say that there's a sort of risk reward analysis that has to be undertaken. If you have already a clearly defined ESG strategy, or you're looking at developing your ESG strategy, and the products fit well with that, then
Yeah.
there is some benefit, I think, in terms of reputation, bringing investors into your structure that wouldn't necessarily otherwise come in to
Yeah.
doing these products. But over the last couple of years in the capital markets, we have seen access to the market quickly being important. And so if you're a debut issuer, it's going to take you some time to get your framework together, to get it second party verified. And so you need to plan ahead if you want to do one of these products and still have ready access to the market. For
Yeah.
those clients who already have established frameworks and they're evolving and tweaking them over time, I think it's been a great product.
Mm.
I do think that the products have a role to play, particularly in driving the conversation forward in organizations. But I'm very much hoping that we get to a world in which actually these are sort of temporary products and we move
Mm.
through them. And eventually it will be, what is your transition strategy? How are you doing from an ESG reputational perspective? And that will form part of the credit assessment as to whether you're
Yeah.
financeable or not. And so I think for now, these products are helpful in driving the discussion forward, but eventually I think we'll move past them, and perhaps some companies are already on that trajectory.
Mm. Mm. Well, that would be good when there isn't two separate sets of definitions. It's simply the way you do finance yourself. I agree with that. Caroline, that was really very interesting indeed. Thank you for that. But for our viewers, we'd very much like to see you at the event itself on the 10th of October in London. Further information is available on the City and Financial website, www.cityandfinancial.com. So please do visit, check out the program and the other speakers. Not too late to make a booking, but it's not far away. Caroline, very much looking forward to seeing you at the event itself. Thank you so much.
You too. Thank you very much.